Yeah, we are just going to go ahead and kick it off here. So thank you everyone for joining us. I'm Deborah Volley. For those of you who don't know, I'm a realtor with the City Living Group here in Nashville. And I have a special guest tonight, Chris Picciurro with Teaching Tax Flow podcast. He is a tax strategy expert and really excited to have him on here. Thank you, Chris, for being here.
My pleasure. It's an honor to be here.
Awesome. Well, I'm going to stop sharing for 1 second and hold this up a little differently. Here we go. All right. So, what to expect tonight? We are going to talk about how to get started in investing for those of you who don't have any investment properties yet. And we're also going to talk about what to do if you have started investing and maybe some strategies that you aren't aware of. So, and then Chris is going to talk to us about tax strategies. There's a lot that came with that big bill that passed and things that you need to know for 2025. So, excited to dig into that. We will have a really quick break if anyone needs it, and then we're just going to jump into some Q&A. And so if you have situations that you have questions about, please, I encourage you to take notes and think of your questions as we kind of go along. And we're going to give you that opportunity in the second half to dive into all of that. So grab your note-taking tools and looking forward to having a fun evening. So we're going to talk about strategy and all the things that come along with that. We've heard a lot of real estate strategies, tax strategies, but what also comes along with that is your mindset. And I think anyone who has gotten into a position where you do have some wealth, you know that the mindset does have a lot to do with that. And then, of course, we're going to talk about you, what it is that you want in your life, and how we like to align what we're doing with our real estate investing and tax strategies with your lifestyle. That's really the whole point of, all of this. So, like I said, I am on a real estate team called the City Living Group here in Nashville. I'm a partner on the team, and our team was founded by Mark Deutschman. And we sell about 200 million a year in real estate. But what got me into real estate in the first place was that I was managing my husband and I's investment properties. So that's why I got my license in the first place. Ended up loving real estate beyond just managing investment properties. And so that is what I do full time. But because of where I started, I work with a lot of investors, and it's what I'm really passionate about. I've seen what investing in real estate has done for me and my family. And I know that a lot of people, especially nowadays, I feel like want a little bit more financial freedom than maybe they had envisioned for themselves in the past. So a lot of times when I talk to people about investing in real estate, they kind of feel stuck. They're not really clear on the direction they should go when it comes to investing in real estate. And, is it too risky? I'm really overwhelmed. There's so many people out there saying so many different things when it comes to investing in real estate. And they're afraid of just chasing a deal, or do they know if it's a really good deal or not? They just have a lot of uncertainty around it. So, the first place I kind of start with people, I kind of make them really take a few steps back because they want to invest in real estate, but what I want to know is why. That's going to really help us with our direction. And I call it finding your freedom number. So to me, that is the number that the amount of money you want to make every month that will give you the life that you want to be living. Not necessarily something that's just going to cover your bills, but what's the life you are aspiring to live? And you might already be there. And that's wonderful. So what does that life look like? And what is the amount of money that you need every month to make that life work for you? So why is this important? Why do we kind of take a step back and talk about this? Well, if let's say you tell me that you want to go to New York City, you're going to take a trip there. Well, the first thing I'm going to ask you is, where are you leaving from, right? I can't get you where you need to go if I don't know where you're starting from. If you're starting in Nashville, we're going to take one route. If you're starting in San Francisco, we're going to take another route. So I need to know where we're starting from in order to get you where you want to be. So we're going to take a little quiz, and we are going to find out what your freedom number is. Now this can take actually a lot of time, but tonight we're just going to do kind of a high level, but it's going to get you really close to a very accurate number for you. So I'm going to pull this up, and let me know if you don't see this. But we're going to take a few minutes here. And oh, I should say also that these surveys that I pull up during the session are all anonymous. So I can't tell who is answering what question. No one can see who it is. So they're all anonymous. So please take a few minutes here and answer these 6 questions. And then we're going to dive into this here a little bit further. And if you just joined us, we're taking a little quiz here to help us figure out what our freedom number is. And if you have any questions about anything, just put it in the chat and Devin will help us out here. All right, we're going to give a couple more minutes here. It looks like almost everyone has turned this in. All right, if you're just joining us, we are taking a really quick quiz here. I'm going to go ahead and keep the quiz open. So if you're just finishing up, go ahead and do that. We're talking about our freedom numbers. So how much money do you need every month to kind of live the life that you really want to be living and kind of aspire to live? And this is obviously something that can take a lot of time and can get really detailed, kind of taking our best guess at some of these right now to give us a general idea. But if you are taking notes, then you would have written down and kind of added this up for yourself. So I'm really curious to know if anyone has ever done this before, and you can kind of answer in the chat, but have you all kind of taken a look at it this way before? I know a lot of people will do a budget, but a lot of times we don't really think about how much it costs to live the life that we want to live. So this is going to help us when we're preparing a strategy for you, looking at that a little closer. So when you're looking at your lifestyle, think about what you're currently juggling. And sometimes when people want to invest in real estate, one of the concerns that I hear from people is that they're worried it's going to take a lot of time. They're worried that it's going to be something that's a heavy lift for them. And so we can talk through, different ways to invest in real estate that may not require such a heavy lift. But I always do encourage people to think about the time that they want something to take in their life, again, so that we can make sure that we're really getting you on the right path. We can kind of look at a few different avatars here. We can think about it as like a corporate Kathy. This is someone who's making a W-2 salary. They have a good savings. They have a 401k. They're a high earner, but they're very dependent on their employer. If they got fired, then they would need to get a job very quickly. They are not sure if they want to stay in the corporate grind forever. So they want to diversify their income, have a little bit more freedom there. And then we can move over to Family Fran and Family Frank. And this is, a couple. They probably have children, could be any age children. They may have dual incomes. They may have just one main earner, but they're pretty comfortable. Although the kids and the expenses that come along with that do kind of make them feel a little stretched. They're pretty steady with their household income, but they're juggling a lot. And they may have an IRA set up. They may have some sort of retirement, but they may not have any other investments and they want passive income. So, and then entrepreneur Erica, this is a client that I work with a lot. I work with a lot of entrepreneurs. So this is a business owner. Their income can be sporadic. When it's good, it's good. When it's bad, it's bad. They have really strong cash flow on those good months and years, but their cash flow is a lot lower. So it can be difficult for them to find financing when they're buying properties. A lot of their assets are tied up in their business. And they do have a fear of burnout, though. Their business requires a lot of their attention and they want some stability. They want to diversify their income. So although these are three different kind of avatars of people, they all have something in common. They all want to diversify their income. They all want a little bit more freedom in their life. And so really even though where they are is very different, a lot of the times where they want to go is very similar. So all that's well and good. And we understand that mindset matters a lot. We understand that we have to know where we are. We have to know where we want to go. But a lot of people are like, show me the money. What does this really look like if I start investing in real estate? It's because it feels so intangible. So I have a couple tools that I show people. And this first screen is just showing you what it would look like if, let's say, you purchased one property a year over 10 years of time, and kind of what your income would be, your total portfolio value. But this is assuming you're paying cash for each property. So that's not a very realistic view for most people, right? So I'm going to jump over here and show you maybe a little bit more realistic view. So we have some assumptions that we've made, and we can kind of play around with these numbers, and I can play around with the properties. So this is something that I can take my clients through and we can kind of come up with a plan. But what most people want to see is this screen, right? They want to see the cash flow. So year 1 through 20 here, and you can kind of see, the cash that they've invested, the money that they've put down on the properties, the loan balances, and also, their equity. at the end of 20 years in this scenario that I have on the screen, they have, $7 to $8 million in assets there. They are cash flowing 150 grand a year. And this is assuming they haven't paid off any of these properties and they still have mortgage payments on all of these properties. What I encourage my clients to do is, pay some of this off by the time you want to retire so that your cash flow, so that you can really live more comfortably. And I know Chris will talk about this in more detail too, but this is not even taking into consideration tax strategies that can help save them even more money and really put more money back in their pocket. So, this is a really broad overview. And again, we can dive into this more in detail in a little bit and kind of play around with this. But this is something that seems to be pretty helpful to people because it really does show them, actual numbers. And so it feels more tangible. It's like, oh, okay, if I started investing today, in 10 years, I could have a portfolio value of $5.5 million. That's pretty cool, right? That seems like something that would be great to have in 10 years. So now we are going to just do one more little pop quiz. And this one only has, I'm going to end this other poll. And this one has just 3 questions. Pull it up here. All right, here it is. All right, this one is just 3 questions. So if everyone can just take a look at this really quickly, this is going to give me a really good idea of kind of why having passive income is important to you. And then also, what is your biggest hurdle in creating passive income? What have you kind of come up against? And, how much time do you think you want to spend managing your investments? And that could be investments other than real estate even. But again, where you are today helps us get where you want to go in the future. So I'm going to keep that open for a couple seconds here.
Deborah, while people are doing that,
Yeah.
just so you know, I think that the chat might be disabled right now because of the number of participants that we
Okay.
have, which is a large number. So
Gotcha. Let me see here. All right. I don't know if I can fix that right now. So, all right, while you guys finish that up, let me see if I can fix that. Okay. That is a learning point for me. So I think I can't fix it right now. So we are going to, if you have questions, feel free to kind of raise your hand. That way we can call on you and get your questions answered. Definitely don't want people to have questions and not get them answered. But we're going to open it up here and chat in a minute anyway. All right. It looks like almost everyone has participated in that quiz. And I'm going to end this poll so I can kind of share the results. So, so here you can kind of see, it's interesting, people have really common goals, but they may have different reasons for wanting to get there, right? So I don't know, that's always interesting to me to see where we kind of align and then where we, have different kind of needs there. And I'm going to hand this over to Chris now. He's going to talk to us about tax strategy. But again, we are all going to kind of dive in and really discuss things in more detail here in a few moments as well. So if you have questions, hold on to those. Let me share my screen here again for you.
Also, the chat might be working now.
Oh, good. Okay.
We'll see.
Oh, awesome. Perfect.
All right. Deborah, thank you so much. First of all, everyone, I really appreciate your time. I do know it is Friday afternoon and, you could be at happy hour right now, but I guess here's a good thing. If you start investing in real estate, you might have a lot of happy hours. So you never know. But I appreciate your time. We're going to open it up for questions later. And I am honored to be speaking with you today. I don't take any of these opportunities for granted. Want to talk about, before we dive in, I want to just talk about the mentality of tax planning and strategy. And I'm a CPA. I've been a licensed CPA for over 25 years. I've been investing in real estate since I was the banker monopoly at 6, and my cousins let me be the banker, but officially in my late 20s. So love it. And it is the niche or segment that our private CPA firm lives, breathes, and works in. So happy to share a little knowledge with you, again, answer some questions. Want to talk about, so my role on the team is doing tax planning and strategy. We've got some amazing people on the team that help on the tax return preparation. Want to talk to you about mentality before we start diving into my top 5 tax strategies for REIs, real estate investors. And, it's really tough as the consumer. It's tough for real estate investors because we're not always sure the difference that you don't always even understand that there's a difference between tax preparation and tax planning and strategy. And you might hear things about tax planning and strategy and really not understand what that even means. And a way to think about that is that tax preparation is compliance. It's taking everything that happened in the past and putting it on a tax form. And there is an art to it. Our goal is to legally and ethically reduce the tax you pay in your lifetime. There are things you can do after the end of the year that could still affect your prior year return. In fact, we're working on wrapping up some, let's say it's end of September, we're working on wrapping up some extensions with using some of the strategies we're going to talk about today. But if you want to think about tax planning and strategy, and the reason I love talking to real estate investors or potential real estate investors is the way you should think about that is that it's everything moving forward. But the better way to think about it is pretend you have a home, pretend you inherited a home, pretend you're flipping a home, and you are at that time to sell that home. And what do you want to do? You want to get the maximum value for that property. Now, you have rules, right? You have to be honest in your seller disclosures, your listing agreement, but there's nothing wrong with hiring a professional stager and staging the home, maybe fixing it up a little bit, painting here and there, renting some furniture, having a designer come in to put it in the best light possible. And that's what we do with tax returns. We want to put them in the best light possible to get you the best result possible based on a variety of different things. So if you're working with a tax professional right now, I'm going to encourage you to say, give them a little grace when it comes to tax planning and strategy. A lot of times they might focus on tax preparation and understand that what I do and what they do are different. However, they are very complementary. And I'm going to share some of that information with you today on some different strategies. So I will mention this. I imagine a lot of people here are in the Middle Tennessee area. So I've been here a little over 9 years. I'm originally from Detroit and my wife and I decided to move here to raise our family, and it's been a blessing. It's been amazing. And luckily we bought property a long time ago here, right? So, but I don't think it's going to go down anytime soon. But let's talk about tax planning, especially for REIs. Now, one more mentality thing. We've developed 3 laws of tax planning, right? Because you need to have a guiding light. The first law is that your tax return is a verb and not a noun. So it's not, if you're thinking about it's something that gets done at the end of the year, it's a PDF. Maybe you're old school and you still get a fancy binder from your accountant. Who knows? But the hay sometimes is in the barn. And that tax return should be something you're thinking about all year round. There should be planning. There should be intention with your decisions. Or else you might not like the result at the end. So just kind of think that your tax return is a verb, not a noun. The second law is that tax flow and cash flow are different. Now, Deborah mentioned our podcast, and it's named Teaching Tax Flow. And tax flow is the tax benefit or burden of any of your financial decisions. And just because you get cash for something doesn't mean, or just because, let's say you're a business owner, like that example, the amount in your bank account doesn't mean that's your taxable income. There's a lot of different examples. Let's say you had a primary residence that you bought it for $500,000 and you sold it for $1.2 million and you're married. Let's say you got $800,000 at closing. Well, the first $500,000, assuming that was a primary residence of that sale, is tax-free. You'd only pay tax on $300,000 in that example. So the point is, big misconception and a point of confusion for taxpayers is that what's in my bank account or what my net income is my taxable income. And we always say, your tax return is a bunch of facts. And if you don't like your tax, you have to change your facts. Last thing, the third thing is that tax agencies are your involuntary business partner. Now, luckily for most of you, I believe I'm wondering, and I'm excited to hear where everyone's from, but in Tennessee, we have no state income tax. That was one of the factors when we moved. So my business partner is the Internal Revenue Service, and tax laws are written to encourage and discourage certain behavior. That's social, that's economic. So once you understand what the defense is, meaning the IRS, then you can play offense. So in football, now, unfortunately, if you live in Middle Tennessee, we're stuck watching the Titans right now. So that's another thing to talk about. But you could think about it in any sport. When you're looking at the defense, you have to make adjustments to your offense. So think that tax laws are meant to encourage. So those tax laws are meant to encourage and discourage certain behavior. Certain industries are very tax advantaged. Real estate is one of the top 2 tax advantaged industries. There's a lot of stuff in the tax code to help people that buy real estate. So narrowing this down to just 5 was challenging, but let's talk about the 5 that you're looking at right now. Top 5 strategies for REIs. Now, I'm going to say one more thing. Ideas are cheap. Implementation is valuable. So I'm going to give you a lot of ideas. And the key is, what I hope that you take away from this is at least one idea that you could either take and implement on your own, work with your tax professional, or if you need someone to talk about, I'm happy to chat with you about it. Okay, so the first one, Deborah was correct. We had a big tax law change, and we call it in our practice and many tax professionals OB3. Sounds like a Star Wars. Like, is that Obi-Wan Kenobi? No, it's OB3. So that's the One Big Beautiful Bill Act, got signed in by the president on July 4th. That act changed a lot of things for real estate investors and business owners in general. The number one thing it did, not the number one of the main things it did is it created bonus depreciation and made bonus depreciation back up to 100%. So that's accelerated depreciation. What does bonus depreciation mean? What that means is that if you purchase any type of personal property, instead of writing it off based on what the asset class is, so that's going to be typically 3, 5, 7, and 15 years, you could take, bless you, an immediate deduction year 1 if you want. Well, that bonus depreciation came into play with the Tax Cuts and Jobs Act of 2017, and it was 100%. But guess what happened? If you're not weren't aware, it started getting phased out. In 2023, it went to 60%. 2023, 80%. 2024, 60. 2025 was going to be 40%. 2026, 20, and then it was gone. Why? Well, because the administration, when the Tax Cuts and Jobs Act of 2017 got passed, one of the negotiations across the aisle was to say, fine, let's put this into place for a temporary period of time, thinking there's no way they weren't going to win a second term. Now, they didn't win a second term. So it was going to get phased out, only to find out that administration came back and won again, and now we have bonus depreciation again. This is not a political conversation, but my job, no matter what, I don't care if Mickey Mouse is the president, Mickey Mouse is going to make some tax laws, and our team has to digest them and use them to our advantage for our clients. So long story long, bonus depreciation is back 100%. So bonus depreciation is something when you buy a fixed asset or personal property for your business or real estate that you get automatically. You have the opportunity to elect out of it, and sometimes you might want to elect out of it. Maybe that deduction would be more valuable to you in a future year, right? We want to pay tax at the lowest marginal tax rate we can. Timing is very important in tax. We continue to have something called Section 179. Section 179 is part of the tax code that allows you to elect to take accelerated depreciation or depreciation for an asset in year one. This does not mean go out and buy new vehicles that are 6,000 pounds just to have a new vehicle. This means, let's say you are a contractor, a home flipper, and you need a piece of equipment. Instead of having to deduct that equipment over 5 years, you can deduct it all year one. Now, I call bonus depreciation in Section 179 cousins. Why? Because they're kind of like each other, but they're both accelerated depreciation. However, bonus depreciation you get automatically, and you have to elect out of. 179 you have to elect into. So the point is, if you are a real estate investor, business owner, and you are buying equipment or fixed assets, make sure you're working with your tax professional to time the deduction for that equipment. Especially if you're an entrepreneur, you know your income is going to go like this. So try to land those depreciation deductions in the higher marginal tax rate years so you get a better impact. All right. The second thing you may have heard of if you're in real estate, cost segregation studies. What is that? Well, let me explain. When you buy a residential piece of property, what happens is you have to depreciate that. Oh my gosh, what is that? Why are we depreciating things? You might be thinking real estate appreciates. It's not a good term. The tax law has some bad terms in it. Ultimately, and that's where sometimes taxpayers say, well, I don't want to depreciate my property. Well, you have to if it's a rental property. Depreciation is just an easier term than calling it cost recovery. So when you buy residential property, you deduct the cost of that property minus land over 27 and a half years, commercial property, 39 years. Well, that's a long time to recover the cost of real estate. And that doesn't matter if you pay cash or get a mortgage. Oh, tax flow versus cash flow. Exactly. Sometimes clients are confused. Well, I paid cash for that property. That's great. Great job of being financially independent and having that ability. It doesn't change your depreciation deduction. Or they could finance almost all of it, right? And they still get the depreciation deduction. What cost segregation study does is it says, okay, within a property, we have things that are personal in nature. Personal property in nature, like windows, landscaping, heating and cooling, electrical systems, et cetera, et cetera. And what we can do within the tax laws is we can look at that property and we can say, out of that, let's say you bought a $600,000 property and $100,000 is allocated to land and $500,000 represents the actual structure. Within that structure, we can go in there and figure out what are the personal property components of that structure. And usually the average is about 24%, but let's say 25% let's say 20% just to be easy. That means $100,000 of that property is personal property. You might be thinking to yourself, what does that have to do with cost segregation studies? Well, if we segregate out the cost, that personal property is what? Eligible for bonus depreciation. So if you have $100,000 of the personal property with allocation within a real property, you can get 100% bonus depreciation for that property. And that's why you're seeing some of the short-term rental markets spike back up because people are able to accelerate the depreciation and take more tax losses. Okay, so that's just cost segregation study. Cool thing about cost seg study, I'll leave you one little tidbit on that. You might be thinking, I wish I knew about this. I bought this short-term rental property in the Gulch 2 years ago. I didn't do the cost segregation study. I'm managing it on my own. It's okay. Remember I said I play Monopoly? Well, no one in my family will play Monopoly with me anymore because I'm a pretty nice guy, but I'm one of the biggest jerks you've ever met when you play Monopoly. I will whittle you down to your last dollar, and then that little dog you're taking around the board, I'm not going to put it back. I'm going to let it lay there on the side of the property where it died. So anyway, that's why no one will play Monopoly with me. However, that's the point I'm bringing up for Monopoly is you have a get out of jail free card. Hey, just for fun, which one? I didn't like the thimble. I always liked the dog when playing Monopoly. Now they have it on video games, but there's something about seeing that money go bye-bye, that hurt. That dog was cute. So, but you know what? I didn't feel as bad when it was the thimble or something else. Anyway, what cool thing with the cost segregation study is this. Let's say you bought a property in 2022. I'm going to go 3 years back in the Gulch, and it's been a short-term rental and you've been managing it on your own. You never did the cost seg. We get a get out of jail free card. We can go back, do a cost segregation study, pretend we did it in 2022, and you're thinking, I already filed that return. That's okay. We can actually make an adjustment on your 2025 return and take any of the bonus depreciation you should have taken in 2022. So the point is, I know I'm getting a little technical. It's called a form, 4115, a 481A adjustment. My point is, if you have rental properties that you think you're going to hold on to for a long time that have not had a cost segregation study, have the conversation with your tax professional if it might make sense. And if you didn't do it when you acquired the property, don't feel like you missed out. I will tell you the hottest properties to do that are the properties with the 100% bonus depreciation. So that's 2018, 2019, 2020, 2021, 22, and then 2023 with the 80%. Oh, we're going to walk in a short-term rental tax loophole now. Yeah, I really don't love the term loophole, but it is part of that is the jargon that we use in our industry. So I'm going to take a step back. Investing in rental properties, by definition, what's called Section 469 of the tax code. So if you get some insomnia tonight, crack that open. Says real estate rental properties, it is a passive activity. And losses from rental property, you might say, why am I buying? Deborah told me I'm going to make a lot of money doing, I have some cash. No, losses on paper from rental properties are typically due to depreciation, but they're not deductible unless the activity is considered non-passive. That means you're real estate professional status, or you own and operate a short-term rental property, hence the short-term rental loophole. So if you own and operate a short-term rental property and you meet a qualification called material participation, any losses from that short-term rental can offset W-2 wages, retirement income, business income, et cetera, et cetera. That property could be located at the beach, could be located. We're in Tennessee, right? We get the best of both worlds. We can go to the mountains, we can go to the beach. It could be anywhere. The key is are you self-managing it? And are you going to meet what's called that material participation threshold? So let me walk you through a very quick example. Real story. We have a client in a private CPA practice. They own and operate short-term rentals. They just bought one up in Maine. It's about $1.4 million. They are going to operate it. And we did a cost segregation study on it. They are going to meet the short-term rental loophole. So the loss from the property will offset W-2 wages. And it just came in that they're going to get a $380,000 immediate tax deduction. So on a $1.3 million property, they probably put down about 20%. Let's just use round numbers. So let's say that's $260,000, give or take. That $380,000 deduction is going to put over $100,000 back in their pocket. So when you're talking about cash on cash ROI, being able to use the short-term rental loophole, and I'm not saying we say don't let the tax tail wag the dog, but if you're considering investing in a short-term rental property, understand that there's a lot of tax advantages. One more thing. you have to meet that material participation threshold. So what a lot of people do is they'll buy a short-term rental property, they'll manage it on their own their first year, hit that short-term rental loophole, and then maybe they'll pass management over the second year to someone else and do it again. And I've seen clients build portfolios, just one short-term rental at a time. They get it up, they get it going, they get it humming, they soak up that big depreciation deduction, and then they do it again. Fourth out of five, 1031 exchange. I've done 1031 exchange. Actually, I've used all these except Roth conversion, but 1031 exchange. Here's the situation. The tax code says this: if you have an investment property and you sell it at a gain, and you don't want to put the money in your hands, you don't need the money, and you're willing to invest that into more real estate, we're going to put you on Santa's good list, and you're not going to have to pay tax on that. That's a 1031 exchange. And what happens is a lot of people get confused because 1031 stands for like-kind exchange. It's part of the tax code, but like-kind is very vague. I've sold a commercial building and bought a short-term rental property. You can sell a short-term rental property and buy a long-term rental property or a commercial building or a self-storage unit. So as long as it's real estate, you can do 1031 exchanges. And believe it or not, I've had clients, and then I'm going to hit Roth conversion, but I've had clients go buy a property, let's say for $400,000, own it for 20 years, basically depreciated almost all of it, sell it, do a 1031 exchange, buy something more expensive, they don't pay any tax on their gain. And then if they own that property until they pass away, all the depreciation they took is wiped clean, and their beneficiaries get what's called a step up in cost basis. So the point is, if you're willing to hold on to the real estate, and as long as you keep deploying it and reinvesting it into more real estate, you can never pay tax on that gain your entire life. And your kids get the property essentially tax-free, because if they sold it, they wouldn't pay, there'd be no capital gain. Now, when you're doing a 1031 exchange, there are rules you have to follow, and you have to use what's called a qualified intermediary. This is not something that you should do by yourself, but you have a team of people to help you out. Final, Roth IRA conversion. You might be thinking, wait a second, these other four strategies reduce my taxable income. Why in the world would this guy put that in there? Well, because, let me tell you a little secret. Tax strategies, or we call tax planning implementations, they don't like to be single. They like to mingle, they like to jingle. They like to be stacked and blended with other strategies. Okay, so for instance, let's say you do one of these strategies. Let's say you do a cost segregation study, and let's say it comes out where you're going to have almost no taxable income in a given year, even though you've made a significant amount of money with your other businesses or on your W-2. That's when you want to pair a Roth conversion. Because remember, if you take money out of a retirement account, a pre-tax account like a Roth or traditional IRA, when you convert it to a Roth, meaning you're just rolling it over to the Roth, that's a taxable event. There's no 10% early distribution penalty, but whatever the tax rate is that year. So real story, and then I'll turn it back over to Deborah. Had a client making $400,000 a year. They bought a short-term rental property in the Smokies. The cost segregation study, because they had been saving money, came out to $450,000. So I had $50,000 of deduction that were going to pretty much go to waste. We were able to take a $100,000 Roth conversion for $8,000 worth of tax. And now they have that money growing tax-free. And if they really wanted to, they could actually buy real estate in that Roth IRA, which is another potential strategy. So those are just my top 5. Again, thanks for your time, and I'm happy to answer questions at the appropriate time.
Thank you, Chris.
My pleasure.
As you guys can see, there's a lot that goes into, you really want to think about the whole picture when you're looking at investing, especially investing in real estate, because of all of these different tax strategies that can really help specifically real estate investors. And Chris does have a QR code here. If you want to schedule time with him, you can scan that. And I'm also going to put it up later. If you don't have your phone on you, you can go grab that, and it's going to come up here later as well. But you can schedule time with Chris, and he can really kind of go into your personal situation, which I highly recommend. You need to, everyone's situation is different. So we're going to take like a 2-minute break here. If you need to go grab your phone, and then we're going to hop back on and think about if you have any questions about investing in real estate, and we can play around with the calculator. And if you don't want to ask your question, you can raise your hand and come on the screen if you want to. You don't have to though. You can also just put your question in the chat and we will read it out. So I will see everyone back here in 2 minutes. All right. Um, we are going to jump in now, and really it's your turn. So if you kind of came on here and you're like, oh my gosh, I'm feeling totally overwhelmed. This is a lot of information. Or, hey, this has made me think about things a little differently, and I have some questions now. Now is the time to kind of ask those questions. And, don't be shy but if you are shy, just put it in the chat and we'll read it out for you. And I'll kind of start with something that I know a lot of people kind of ask, or I kind of get into conversations with people about is, what is your biggest hurdle right now when it comes to investing in real estate? And of course, this is going to be different for everyone, but a lot of times the biggest hurdle is just I'm so afraid of making the wrong choice. And I just have this decision atrophy, right? There's so many options out there, and I'm just not sure what to do. This is a big deal to buy my first investment property or my second or third, and I just don't want to make the wrong decision. Especially when you hear of people kind of waiting for rates to go down. Is this even the right time to buy? I think what I really like to show people is something like this where it shows you what time does for your investments. Time is your friend when it comes to real estate. And I am a big proponent of holding on to your real estate if you can. And the reason is because the market historically has always gone up everywhere over time. it will have dips and it will, have some volatility, but over time it always goes up. We're not going to see our home values go back to what they were in 1950, right? So it's one of those things where if you are going to hold your property for 5 to 10 years, you have a really, really good chance of it going up in value unless something really strange happens that's like very specific to that area or that property. So, the property that you buy today for $500,000 in 20 years, that's going to grow into, potentially a million, and a half. Especially if you're looking at a 20-year growth trajectory. So depending on your age and when you want to be kind of financially stable, right? So the best time to buy real estate is usually yesterday, and the second best time is today. And then when it comes to what is the right property to purchase, that is where, you can, that's where I can dig in with people, and it depends on their personal situation, right? Anyone have a question?
Has anyone done a cost segregation study yet? Just out of curiosity on any of their.
Doing one right now.
Awesome. Well, that's something I probably should have I could have mentioned. The nice thing about the cost seg study is that you don't have to do that before the end of the year. You could go back to previous years, and if your tax turns on extension, you could still do one now and count it for 2024. So that's why we're seeing a lot of them through our office right now. Yeah.
Yep. Actually, mine is going back to a property that I purchased in 2022, and
Oh, nice.
which is a 100% cost segregation year. So excited about that. Yeah, Joe, go ahead.
Did you hire that done?
Oh, Paul, I think you unmuted there.
Yes, I wanted to ask you a question.
Yeah, go ahead.
This cost segregation, did you hire it done or did you do it on your own?
Oh, no, you have to hire it out. This is something that has to be done by someone who is accredited, and Chris can speak more to that.
Yeah. So there are some DIY solutions in the cost segregation space. I'm not a big fan of them, we'll say. I know people that own those companies and I like them personally. What you're going to want to think about though is working with a company that's going to either that's going to give you audit protection and do something and be very IRS compliant, especially if you're going back to a previous year. Those are very complex calculations. You're with, like for Deborah's property, it sounds like she bought in a previous year. They've got to calculate what the depreciation would have been had the bonus depreciation been taken in 22, back out the amount that was already taken and make that adjustment. And we're talking about big numbers here. Now, I would say typically, if the property basis is $1 million or less, most of the very reputable companies will, at that point, they might do a satellite analysis and look at property tax records and a survey for the segregation study. If it's $1 million or more, they might do a site visit. I would bet, on the average is an 8 to 10x. But when you're looking at the cost. So if a cost segregation study, the one I just mentioned, the gentleman that's going to get a $385,000 deduction, well over $100,000 of tax reduction was $5,000. I've seen them lower. I've seen them higher. But ultimately it comes down to, is the juice worth the squeeze?
And Paul, a lot of times when you talk to the cost segregation study company, they will do a quick analysis for you. They're not going to charge you that, and then you're not going to really get much back. They'll usually do an analysis and then say, hey, we think you'll at least get this much, and here's what it'll cost. And so then you can kind of make that decision if it's worth it or not. But definitely worth kind of looking into.
Yeah, I should have mentioned that. They will do that. If you have a relationship with a real estate broker or CPA, they'll go out and they will do and usually the analysis comes in worse. They're not going to overpromise, right? So they're going to give you a ballpark and it's going to come in better.
Yeah. Joe.
Sorry, that actually was my question.
Okay.
Similar, but follow-up question to that. So what, and maybe you already answered it and I just missed it, but how do you find a reputable person to do that? And do they have to be located in the same place as the rental? So if I have a place in Knoxville, do I need to find a company that's in Knoxville?
Right. No, you don't have to have someone specifically in Knoxville. I don't, Deborah might have a relationship with a company that she would recommend. We have one that we recommend. I've worked with several, but the one we recommend, I really, really like, or else I wouldn't be recommending them. The only thing I would make sure that you, like when you get the deduction calculation, that doesn't necessarily guarantee you could take all that deduction year one. So we got to understand that you are either, for the IRS purposes, a passive investor or a non-passive investor. If you're a non-passive investor, meaning you meet real estate professional status or short-term rental loophole, you can take that deduction against your current year income. If you're a passive investor, the deduction is still valuable. It'll offset any type of passive income that you have. And if the deduction exceeds that passive income, it just carries forward. And that's something that a lot of taxpayers don't realize. Like, let's say I'm going to make an example. Let's say you purchased a new home for $500,000. I'm just going to make up a number. And you did the cost segregation study and it was a rental property. And you're a passive investor. And that home's netting you, I'm just going to, like $500 a month. I'm just making numbers up. Well, if you do the cost segregation study, you might not pay tax on that for 10, 11 years because you created this passive activity loss. You created this big deduction just because you can't use it year one. If I told you, hey, you're going to buy a piece of real estate, you're going to buy something, it's going to go up in value, it's going to produce income for you, and you won't pay any tax on that for the next 10 to 12 years. That sounds pretty good. But sometimes people get so caught up on, I need that deduction today. And ultimately, having the deduction or that tax-free cash flow could be powerful.
And you can go back 3 years, right, Chris?
Yeah, good question. So you can go back, you can amend a tax return for up to 3 years, but you can go back as long as you want. That being said, before the Tax Cuts and Jobs Act of 2017, we couldn't do cost segregation studies, or we couldn't take bonus depreciation on the 5, 7, and 15-year asset classes. So if you have a property you purchased in 2010, the juice really won't be there too much because we've already depreciated it for 25 of the 27 or 15 of the 27 years. So what you're looking for, that sweet spot, 2018 to 2023, and then 2024. 24 is okay, it's 60%. It depends on the value of the property, but 2018 to 2022 is a sweet spot, and now we're back in a sweet spot.
The chat, there's also another question from Dominique.
Yeah.
What do you consider investor ready? Is there a recommended price range that someone should have before considering investing?
Yeah, so investor ready is, going to be situation dependent, but of course, what I suggest is that if you are going to invest in real estate, you really want to make sure that you don't get yourself in a situation where you're over leveraged and in a place where, let's say your tenant doesn't pay rent for a couple months, or it takes you a couple months longer than you think it's going to get a tenant in your property. You don't want to be left, holding the bag and not be able to cover your expenses. So I always suggest that someone has 3 to 6 months at least of expenses kind of in an account, and in addition to the money you're going to need to put down on the property. A lot of people, might get themselves into a situation where they're maybe only putting 3.5% to 5% down on a property, but then your payment is so high that a lot of times the rent's not going to cover that. And so if you have, that's okay to do. Sometimes we do that because maybe it's only a few $100s and you can cover that every month comfortably. And you're looking at a long-term play, right? You're looking at retiring with that. in, 10 to 15 years. So it's fine to be, and your rent's going to go up over time. And so you're going to eventually cover that mortgage payment. So it's not that I'm saying don't do that, but in that situation, you just don't want to get yourself in a place where if someone's not renting it out for a few months, that you can't afford the property. So that's kind of like a good rule of thumb for people, is to have at least 3 to 6 months of expenses set aside so that you cover it if you really, really needed to. Let's see. I know a lot of people are from Nashville that are on the call, but not everyone is. One thing I will say is local markets. Sometimes, in Nashville, we have this great growing market, right? So it's a good real estate market because we have so much growth projected for the next 5 to 10 years in our city. But sometimes we live in areas that don't have that type of growth. And so sometimes you don't want to invest in your local market. You want to invest in a city that's kind of growing. And that's something that you can kind of talk about with your realtor as well. I know that if you are buying in your local area, again, that can be a really good kind of long-term play, because over time, those are still going to increase in value, but they may not increase in value as rapidly as a growing area. Let's see, in the chat, let's see, after divorce, getting a new mortgage, new terms, etc., within the last 5 years, is cost segregation possible in this scenario?
Okay, so thanks for the question. Is this a primary residence or a investment property? That would be
Primary.
Yeah. So okay, good question. So with a primary residence, I'm going to talk about a couple really cool tax advantages of a primary residence. That being said, on a primary residence, you're not taking the depreciation deduction because you're not renting it out. You're living there as a primary residence. That said, you're going to qualify, if it's your primary residence, at least 2 of the last 5 years for what's called the Section 121 exclusion. And that means that you, depending on your filing status, you can exclude from capital gain $250,000, or married joint $500,000. The other thing is you can take advantage of something called the Augusta rule. The Augusta rule, you might have heard about it because on TikTok or some of these other people saying, oh, go rent this to your business. If used properly, it can really work well. But the Augusta rule says you can rent your property out for up to 14 days, your primary residence, and pay no tax on the income. Now, not everyone would want someone trouncing around their house. But if you live in the Middle Tennessee area and you don't want to be around during CMA Fest, or we get a Super Bowl in a couple of years, and you want to put a lot of money in your pocket, tax-free, you can do that. The other cool thing about primary residence is you're taking expenses that are typically personal in nature, like mortgage interest or like rent would be personal. There's no deduction, making it into, but your property taxes and your mortgage interest could be deductible if you itemize. So again, the tax law favors people that buy a primary residence.
And I'll just say that a lot of CPAs are not as familiar with all of these different tax strategies. So it's really important when you are talking to your CPA to find out if they can help you with this. I know I've recently had to switch CPAs, and nothing, bad towards that CPA, but they just weren't knowledgeable when it came to real estate investors and all of the the strategies that could really help save me a lot of money, especially as a small business owner. So, that's, if you start asking your CPA some questions about the things that Chris is talking about and they don't know what he's talking about, then that's kind of a sign to start looking around. And I'll say, if you schedule a call with Chris, he can give you, recommendations on CPAs, but also someone who can do a cost segregation study. I have people as well, but when you're doing the cost segregation, I will say one thing to really look for, and Chris mentioned this already, but make sure that they can stand through an audit, because a lot of them say they will. It's very limited in what they can do as far as protecting you through an audit. So that's one thing I will say to look for there. Yeah, Joe.
Sorry, I always have questions. So this is also for Chris. So I see a lot of TikTok things saying that, you know, if you have rental properties, you absolutely need to be putting them in an LLC. I also know that LLCs have their own tax advantages and disadvantages. Does he have any recommendations as far as the best structure to have rentals in? Should each rental property have its own LLC or corporation? Just could he talk to that a little bit?
Right, right. Well, thank you for asking that question. I was just looking. The IRS just came out and a little
Oh,
bit of
got it. There you go.
okay, is okay, cool. So I'm going to preface this by saying we make a lot of social media content, not on TikTok, but on other outlets. That's very informative. However, the IRS just came out, and I'm looking for that penalty, but it was millions and millions of dollars were just assessed to people giving out bad tax advice. So I got to find that. I should make a TikTok video about the TikTokers. Thanks for the question, Joe. Keep in mind, ideas are cheap, implementation's valuable. So when it comes to LLCs, there's no tax advantage to an LLC. Doesn't mean it's a bad idea, but a single member LLC, for instance, is a disregarded entity for federal tax purposes. That means it doesn't matter. If you put a rental property in a single member LLC, it still gets reported on Schedule E. If you own a business in a single member LLC, it still gets reported on Schedule C. So what does an LLC do for you? It's an asset protection tool. Okay. And so it's not a financial strategy necessarily, but it's an asset protection tool. And that's something that, CPAs and attorneys might disagree on. You've got to keep in mind a couple of things. If you own all of your rental properties free and clear, you might want to consider putting them in LLCs. However, if you have a mortgage on them, you've just got to be careful about what's called a due on sale clause. You'd want to contact your mortgage company to make sure you can deed the property. I'm not an attorney, but you could deed the property into the LLC. The other thing, let's talk about the tax part. On the federal tax side of it, it's a wash. Doesn't matter, no advantage. Tax deductions are given out. So you can deduct some on your tax return, what's an ordinary and necessary in your business. It doesn't matter if you have an entity. Number two, let's talk about state of Tennessee. State of Tennessee, we have a Tennessee franchise and excise tax. So once you create an LLC, you are now subject to this tax. The tax has gotten better, for lack of a better term. We now have an income threshold and an asset threshold, but it's 6.5% of your net income. And I think it's like 0.5% of the total assets. That being said, if you own a rental property in the state of Tennessee and you're a resident of the state of Tennessee and you own it personally, you might qualify for what's called a FONS exemption. FONS stands for family-owned non-corporate entity. So you might be exempt. Most LLCs that are owned by individuals that own rental property here in Tennessee, most of them qualify for the FONS exemption that you have to apply for year to year. But the challenge is once you sell that property, you don't have the FONS exemption anymore, and you're going to pay tax, an extra 6.5% tax on that sale. And there's a year look back period. So some people say, well, I'll just deed it out of my LLC the day before I sell it. There's a year look back period in the department. I work closely. I'm very fortunate to be on the, part of the Tennessee Society of CPAs, and we go spend a day at the Hill every year, talk to our Department of Revenue, talk to our Department of Social, Secretary of State rather, about these issues. So I know where the enforcement's coming. The whole LLC thing, it does, I don't know you guys well enough to tell you how much it annoys me when I hear people giving out bad advice, but that's okay. And I feel bad for you because and I have one more thing. There's one more unintended consequence with an LLC. Let's say there are two spouses. You're here in Tennessee, so a non-community property state, and you form a multi-member LLC and you put your rental properties in it. I'm not saying it's bad, but what I'm saying is now you have to file a partnership tax return. It's going to cost you at least $2,000 to $3,000 more per year per LLC to be an LLC. So if that's worth it, if I own a even a $5 million apartment complex, absolutely. But so there's a lot of factors involved.
Yep, absolutely. Very, very good.
So you don't like them in LLCs?
I wouldn't say it depends. Everything's situationally dependent. If the property, so sometimes, well, first of all, if it's got a mortgage, you have to make sure that you could even put it in the LLC. That's the first thing. You want to make sure you qualify for the fonts exemption, and you want to make sure you want to see how long you're going to own it. Because I tell you what, I can't tell you how many clients we've had come to us from someone else that get some bad advice, go form a Wyoming holding company in 20 LLCs for the 20 rental properties. And if they're all in Tennessee, you don't get the fonts exemption because the LLC owns an LLC. We're talking, $30,000, $40,000 of franchise tax these people owe now because of this. So I'm not saying I hate to sound like too legalese, because I'm not an attorney anyway, but it's not that I don't like it. The shoe has to be on the right foot. So depending on your portfolio, sometimes an LLC is necessary. So if everyone in this chat said, let's go buy 2 new condos, in the Gulch or East Nashville, they're very expensive. So we're all going to throw in $25,000, $50,000. At that point, yeah, we should probably form an LLC because we don't know each other. We want to have some asset protection from each other. And you want to make sure that if something happens to one of us, that things, that LLC interest goes to our beneficiaries, or the LLC will dictate where do people buy each other out and that sort of stuff. So I know I hate not giving you a firm answer. So in general, I'm anti LLC unless you need one. How about that? That's what I would say.
So let's say like you didn't do it
Mhm.
and a tenant sues you.
Right.
Are they now able to have access to everything you own without LLCs?
So they could, yeah. So that's the negative of the advantage of the LLC is asset protection. So what you'd have to think about is, what's your risk tolerance? Do you have an umbrella policy? Do you have homeowners insurance? If you're managing your own properties, LLCs might make a little more sense because you're making more decisions. But if you have a third-party property manager and they're doing the tenant screening, and you have a mortgage on the property and there's not a lot of equity in it, you got to look at everything. Look at what type of property it is, where it is. Short-term rental properties tend to have higher risk, so it might make more sense. And then sometimes lenders require the LLC. So if you're doing like what's called a DSCR loan, debt coverage, my brain's already, debt coverage.
Debt service coverage.
Yeah, debt service, sorry. Better with numbers than letters. Then a lot of times they want that in a separate LLC. There's one more factor, especially in Nashville. Sometimes you can't transfer a short-term rental permit. So if you're buying a short-term rental property in an LLC, sometimes you have to buy the actual LLC. You can't buy it and put it in your name. Deborah would know more about that. So I hate to say it depends, but it kind of depends.
If you have assets to protect, it seems like sometimes that is when you do want an LLC. But if you have a mortgage on the property and you have someone else managing it, then you really need to look a little closely. Is that accurate? Or
Yes. That's a good way to say it.
I want to share the results of that first Freedom Number poll so everyone can kind of get a little idea. Can everyone see that now? Can you see so it's interesting to see, kind of on average. I'm just going to scroll down to where everyone, thinks their Freedom Number is, and you can see it's very different across the board. And what's interesting is how doable it is with a real estate portfolio to achieve these numbers, even the 50 to 60,000 a month. And so really over a 10-year period of time, and of course it's growing gradually over that time, right? It's not like you have to wait 10 years to see that every month. Like it's growing and getting you there. But you can really get to a place where you don't have to do your 9 to 5 anymore if you do a 9 to 5, or you can really focus on what you're passionate about because you're not worried about your bills every month, right? So it's kind of interesting to see how doable it really is when you look at it that way, because a lot of times we think we need $5 million or we need $10 million to be able to kind of live the way we want. And really it's, I need 5 properties. And then let's see, Paul, can bonus depreciation be used for new roofs, repaving a parking lot, or upgrading HVAC or electrical?
Right. Great question. So a roof is typically going to be 27-year property, but here's how but the answer is it could be. So as far as repaving the parking lot's a 15-year asset, so absolutely, you get the bonus depreciation. HVAC and electrical, yes. When could it be roof? It kind of depends on the situation, but here's what could happen. I've seen situations where, let's say they're bigger assets. Let's say you bought a $10 million apartment building and there's, different investors. You need a new roof. Even though the new roof, you have to depreciate over the 27 and a half years. Let's say if you do a cost segregation study and it's deemed that $600,000 is allocable to the roof, but then you have to tear that roof off, then you've disposed of that and you actually get the $600,000 deduction. So indirectly, the answer is yes, but I just don't want you to go out on TikTok now to your friends, Paul, and tell them that they could depreciate their roof on bonus depreciation.
Paul would never. All right. If there are no more questions, if there are, feel free to put them in the chat there. But if there are no more questions, I'm just going to jump back over here and just do a last little few questions to kind of end the session here. And then I'm going to pull up the QR codes for myself and Chris if you guys have questions that are kind of beyond, what we've talked about today. And this is something that can kind of be, this is really just for me. Was this helpful? Was it not helpful? 5 quick questions here. And, let me know your thoughts. And as you're doing that, I'm going to pull up the QR code for a one-on-one with me. But I'm looking at everyone on the call, and I think everyone here knows how to get a hold of me. So I am going to go onto Chris's QR code. So if you have questions, I know we had a lot of bonus depreciation questions. It's something that's a really hot topic right now. Not everyone understands it, and it can really can save you a lot of money, but it is something that you have to look at very particular to your situation, like Chris was saying. So please scan that QR code, reach out to him, schedule time. And, Chris, do you have anything else to add kind of as we're closing down here?
Right. No, I did post that. I just came out from the IRS earlier this month that they nailed $162 million of penalties over to these fake tax advisors. My advice is, if you're getting into real estate, definitely work with a good CPA firm. I'm going to give you a little bit of inside baseball. 75% of CPAs are retiring in the next 15 years. So if you have a good relationship, lean into that and understand that we don't have a crystal ball, so we might not know what's going on unless you tell us. But if you're in a situation where you have questions specifically about real estate, or you're a business owner, and you just want maybe someone to talk through it with you, I'm happy to chat through it, have a chat. And realize too, not every tax planning opportunity has to be for this year. There are things that could set you up for the future. And I really appreciate it.
Yeah. When you're talking about investing, it's such a good idea, guys, to get your tax advisor, your CPA. Those probably are 2 different people, all on the same page and all kind of talking to each other. A lot of people kind of use a best practice of making sure that all of those people are on a meeting at the beginning of the tax season. So you're planning what you're going to be doing. We're towards the end of 2025. It's, there's not much you can do right now in 2025. We still have some of the year left, but you really want to have those meetings at the beginning of every year, because once you're filing your taxes, it's kind of too late, right? to take advantage of anything for that.
Right. So, right. That's definitely more limited as far as what you can do for a previous year. You know, when you right now, what we have everything available to us, but it does shrink down as the year goes on. And there are some things you do post year end, but not. You're right. Not as many things as you could do right now. And think to yourself, it's what? It's 9/20. It's the 26th. If the year ended on September 30th, do you know where you're at right now? And if you do know where you're at, which most people probably don't, do you like it? Are you happy? If you could change something, what would you change? And can you change it? So some things are behavioral, some things are financial. In other words, some things might be, I want to invest into this, or I just might change something here. So yep, knowing where you're at is very important. Just like you mentioned in the very beginning, if you want to figure out where you're going, you got to know where you're at.
Awesome. Well, thank you everyone for joining the call. And, I call this holistic real estate investing because we look at everything. We look at the whole picture. And if you, have any questions, obviously, you know where to reach me. And then hopefully you all shot that QR code for Chris and getting a hold of him. So thank you, everyone. And I hope you have a great Friday night. You still got a half an hour left with happy hour. So.
All right.
Thank you, everyone.